Have you ever opened up a stock chart and felt like you were just staring at a chaotic, completely random mess of red and green lines? Yeah, if you have, you are definitely not alone. But what if I told you that those seemingly random shapes aren't chaotic at all? They're actually telling you a story. See, every single chart is this dynamic minute-by-minute battlefield narrative between two massive forces, the buyers and the sellers. Welcome to this explainer. Today, we're going to translate that battlefield. We're going to give you the ultimate decoder ring so you can finally understand the language of candlestick patterns.
Okay, let's dive into this. Here is our roadmap for today. First up, decoding the market's language, followed by the anatomy of a candlestick. Then we'll look at bullish patterns, where the buyers attack, bearish patterns where the sellers retaliate, and neutral patterns which are basically a standoff. Finally, we'll wrap up with the rules of the trade.
Section 1. Decoding the market's language.
To really read these charts, you've got to view price action as a constant, aggressive tug-of-war. Literally every single price movement represents either successfully captured territory or a completely failed advance. Once you start seeing the chart as this footprint of human psychology and market pressure, well, everything changes. So let's start with our fundamental alphabet. A candle is simply a graphical representation of data showing price movement over a specific period of time. And every single candle is made up of 5 crucial parts: the open, the close, the high, the low, and the body. If you can read these 5 parts, you can absolutely read the heartbeat of the market.
Section 2. Anatomy of a candlestick.
So, moving on to the anatomy, think of a green bullish candle and a red bearish candle. That thick colored rectangle in the middle? That's the body. This solid body represents captured territory. It's the actual difference between where the price opened and where it closed. Now think about those thin lines poking out of the top and bottom. Those are the wicks or shadows, and they represent failed advances. They show us the absolute highest and lowest prices reached during that time, revealing exactly where the bulls or the bears pushed the line, but ultimately just couldn't hold their ground.
Section 3. Bullish patterns. Buyers attack. These bullish patterns typically pop up at the very bottom of a downtrend, right when sellers exhaust themselves and buyers finally launch their attack. Our first major signal is the hammer, and this brilliantly illustrates that shift. Imagine an exceptionally long lower wick. It has to be at least twice the size of the small body at the top. This wick tells such a dramatic story. The sellers aggressively pushed the price down, thinking they were in total control, but they completely overextended. The buyers stepped in, absolutely rejected those lower prices, and regained control, pushing the price all the way back up. It's a really powerful counterattack signaling a potential upward reversal.
Sometimes, though, the story takes a little longer to unfold, kind of like a 3-act play. Enter the Morning Star, which is a 3-candle narrative. Act 1 is a large red bearish drop where sellers are dominating. Act 2 is a tiny indecision candle, could be red or green, showing the downward momentum has suddenly halted. And Act 3, a massive green bullish takeover that closes well past the midpoint of that first red candle. The sellers lost control and the buyers have definitively taken over.
Section 4. Bearish patterns. Sellers retaliate.
But the buyers don't win every single battle. Let's shift the narrative to the top of an uptrend and compare 2 incredible psychological flips: the bullish engulfing versus the bearish engulfing pattern. In the bearish engulfing pattern, which happens right at the top of an uptrend, a small green candle is completely swallowed up, or engulfed, by a massive red candle right after it. It is the exact inverse relationship of market psychology from the bottom of a trend. It visually proves that whatever ground the buyers just took, the sellers instantly wiped it out with overwhelming force.
Then we have the shooting star, which is another really powerful bearish signal. It's essentially the exact opposite of the hammer we just talked about. Found at the top of an uptrend, it features a small body at the bottom and an extremely long upper wick. That long upper wick visibly proves that the buyers boldly attempted to push the price even higher, but were completely crushed by a sudden influx of sellers who slammed the price right back down.
And then there's the ominous gravestone doji. It looks exactly like an eerie inverted T. The open, low, and close are all practically at the exact same level, leaving this massive wick pointing straight up. When you spot this specific shape sitting at the top of a long uptrend, it is a very strong potential reversal signal. Basically, the buyers gave it absolutely everything they had to advance, but the sellers forced them into a complete and total retreat.
Section 5. Neutral patterns. The standoff.
So what happens when neither side can gain an inch? Well, we get a tense standoff where buyers and sellers are completely deadlocked. To understand these neutral patterns, we first need to define the word doji. Doji is a Japanese term that translates to the same thing. In the context of our market battlefield, it indicates profound uncertainty and extreme indecision.
When a doji pattern appears, it's like a giant flashing yellow light signaling to traders that they must proceed very cautiously because momentum has officially paused.
Now, what's really interesting about this is how that indecision is visually represented. A true doji has no colored body at all. The opening price and the closing price are exactly the same. The wicks show that both buyers and sellers tried their absolute hardest to push the price during the session, but ultimately, they ended up in a perfect frozen balance. Neither side could secure a victory.
Very similar to the doji is the spinning top. With this one, we do have a tiny body, which can be green or red, but the defining feature here is the long upper and lower wicks on both sides. Those long wicks prove there was incredibly high pressure and a massive fight coming from both directions. Yet, because that body is just so small, we know that despite all that violent tug of war, no one actually won the battle. The market is just sitting there, waiting for a catalyst to pick a direction.
Section 6. Rules of the Trade.
Understanding the language of these candles is incredibly empowering. But simply reading the language isn't enough. You actually have to know how to act on it safely, because context is everything. A hammer candle floating in the middle of nowhere means very little. These patterns are significantly stronger and far more reliable when you identify them at key support or resistance levels on your chart. Plus, you always want to look for high trading volume. High volume acts as the fuel that validates the move. And above all, never trade blindly. You must always wait for the next candle.
Throughout the source material, a universal step-by-step risk management strategy is repeated like a comforting rhythm. So let's break it down. Step 1. Identify your candlestick pattern. Step 2. Wait for next candle confirmation to prove the reversal is real. Step 3. Protect your capital by setting a stop loss just above or below the wick of your pattern. And Step 4. Always target at least a 1-to-2 risk-reward ratio. You always want your potential reward to be double your risk.
So, the crucial point is this. Never trade without confirmation. I cannot stress this enough. This is the single most repeated warning from all of our source data. Spotting a beautiful morning star or a perfect bearish engulfing pattern is completely meaningless if the very next candle doesn't move in the direction of the new trend to confirm it. Honestly, patience is what separates the gamblers from the strategists.
We've covered a whole lot of ground today, from the basic anatomy of a candle to the precise tactics of bullish attacks, bearish ambushes, and neutral standoffs. Armed with these patterns and the strict rules of engagement, you now have the tools to read the hidden story behind the price. I bet you'll never look at a chaotic stock chart the exact same way again. The only question left is, are you ready to take this decoder ring and decode the battlefield on your own charts? Thanks for joining me on this explainer, and hey, happy charting!